Well, I mentioned that volatility, particularly Friday and Monday, worst trading days since 2020. So let's just take a step back and look how a solid investment framework can help you just sleep well at night, even through turbulent times. Does that sound good? For more on some strategy, Roger Parrott, financial advisor at Freshwater Wealth, joins me here on the desk. Roger, so nice to have you here back with us. So yeah, that volatility, it was pretty intense. I can only imagine you did receive a few phone calls.
Yeah, absolutely. It's been like a great period of time, right? I think up until Thursday, I think like a balanced investor was getting 13%, almost probably had forgotten what volatility was like. But certainly Friday and Monday, really, yeah, some large down days. Interesting, some were nervous, but some also saw it as a buying opportunity. So
yeah, well, that's the thing. And when you consider that markets were at record heights, going into this bout of volatility, you can understand that, you'd have whiplash, really, if you're an investor picking up your phone, looking at your portfolio on a day-to-day basis. So when you think about, what was really driving the volatility, a lot of it was, the lack of breadth in U.S. markets, the overexposure to AI. I mean, let's just leave the Bank of Japan and the yen carry trade to the side.
Sure.
Like, there were a lot of these trades that were fairly stretched. Is that your view?
Yeah, that's right. And the job market data out of the US was probably lower than expected, so there was that recession fear as well. So there was sort of probably a number of factors that all together, people were concerned, and it caused quite a big sell-off. So yeah.
So did you have a lot of your clients calling you and say, Roger, what's going on? What should I be doing? Like, what's your view on acting through those real bouts of volatility?
Yeah, sure. So to be honest, we don't actually have too many clients call, because I think what I really try and do with our clients is continuing to educate them to make sure that they are aware that this volatility is absolutely normal. And every time I catch up with them, I like to remind them that they're going to have a correction. And not that I have a crystal ball or anything like that, but it's more just to prepare them, so when it then happens, they're not going to panic, they're not going to worry. They're like, yeah, that's right, Roger told me this was going to happen, and hopefully give them that peace of mind and confidence, like you say.
So that's based on having just a framework in place, having a plan put down. So when you start to put a plan together or get this framework in place, where do you start?
Yeah, I think it's always a good place to start with the client's goals. So when we have clients come to see us, sometimes it's a performance goal. I really want that percentage. Mm-hmm. But sometimes it's like, no, I just want to beat inflation. But sometimes, very wealthy investors, they almost don't even have to take any risk at all, right? They've got enough money to live, they've got enough money for their lifestyle. So sometimes their goal is really maybe a performance target to set their family up for the future. So I think it's important to understand, what the level of return they're really seeking, and that's probably where it starts.
And then also risk tolerance, though, because that's very individual.
Yeah, that's right. And that's probably the second sort of things in terms of a solid framework. And risk is different to different people, right? So I've had some people come and see me and they say, I'm very, very conservative. Mm-hmm. And yet they're business owners, they're borrowed against their house, they're borrowed against to invest, or their business. And I'm like, I don't think, you may perceive yourself as being quite conservative, but I probably wouldn't suggest that, because I then also have on the flip side, other people come and say, I'm very, very aggressive, yet when I look, I don't think, they are at all. So sometimes it's good to have an objective way to understand a level of risk someone's happy to take.
So what are some key investment principles that sort of go across the spectrum, whether you're very risk adverse or very aggressive, or if you're trying to achieve a set, performance percentage, or if you just want to have a comfy retirement, set your family up well? Yeah,
that's right. So we have a sort of a questionnaire that we go through. So obviously we can't do that today, but generally we've got clients zero, meaning that all their money is guaranteed, it's in the bank. It's liquid, probably don't get too much of a return, right through to say a 10, where in that case they're probably all in equities. Now most clients fit somewhere along that spectrum, and it's really trying to understand where that they sit. Now, to get a good understanding of where they sit, not only is the performance target important, but then, as you said, the volatility I think is super important. And the way I normally like to frame it is in terms of three numbers. One is how often we're going to see a negative year. So if people feel comfortable, once every 6 years, or I'm comfortable with that, that's a good measure in terms of how comfortable they'll be. The second thing I think is like an average negative year. You know, if you say, oh, look, once every 6 or 7 years, maybe a 10% down, all the rest are obviously positive and give you that average target. Okay, that's probably a good way to make people feel comfortable as well. And I think the third one is how bad can it get? So if it's like really, really bad, like in a COVID, those sort of once in 10 year type events, a COVID or a GFC, like what's the worst volatility I'm going to get? And call it like negative 25%. And that sort of summarises those numbers. You've got a performance target, how often it's negative, the average negative return in the worst case. I think is a pretty nice way to summarise, in terms of their risk profile, if you like. So that's probably the first step in terms of the principles, really understanding the risk profile. Then there's other things like diversification, not putting all your money in one asset class or one basket or one strategy. Not investing everything, do you know what I mean? If you invest everything and then you need some money for whatever it may be, you may have to be forced to sell at a loss at those down times, so making sure you've got a good buffer. So those things on liquidity, diversification, I think they're super key as well.
And just on the diversification piece, only because we've had quite a conversation going here on AusBiz about 60-40, bonds, equities. Is that old school for you? Do you involve your clients in alts, alternatives? Do you look to get those true diversifiers into some portfolios?
Yeah, sure. I do. Do you know what I mean? So, and you're right, like alts at the moment, a bit of a buzzword type of thing. So, I certainly use them. They're good from a volatility. They're also good from a diversification perspective. So I certainly use them in my clients' portfolios.
Okay, so when we talk about those three numbers that you really get people across to determine their risk appetite, maybe that's why you didn't get your phone's ringing off the hook on Friday or Monday. Right. But did you look at some of the? I mean, if we even just to talk equities, yep. Some of the selling as an opportunity potentially to get set.
Absolutely, yeah. So so I think I mentioned. So some clients are seeing this as a buying opportunity. Some a little bit, what should we do? So and it's interesting in terms of the buying opportunity, like what day is it? So sometimes like that sort of dollar cost averaging strategy is good as well, because maybe Monday was a great day, but maybe there's more opportunities to come. So instead of just, if you do have money available, instead of choosing a day and hoping that's the best day, maybe sort of investing it over a period is a wise strategy as well.